This month, interest rates topped the conversations in real estate and the housing market here in South Orange County. So when interest rates dipped in August, buyers took advantage of that, and we saw that reflected in September. So as you would expect, prices went up about 3%. I'm Jim with the Bishop team. We're gonna dive into our South Orange County real estate market update, so stay tuned. To get information like this and other information that's going to help you make the right decisions for you and your family, click on the subscribe button and hopefully you can leave a like and even a comment. While supply and demand ultimately rule the day in terms of what happens in housing and housing prices, interest rates have created a bigger and bigger role in our local real estate market. If you look at these graphs, you'll see how very quickly interest rates rose. Remember that low rates fueled huge buyer demand as we came out of the lockdowns. Cheap money allowed buyers to bid on properties and compete against other buyers without a huge impact on their monthly cost. When the money faucet stayed on too long and at too high a pace, it really threw everything into turmoil, and that's what you're seeing in terms of inflation and pretty much across the board everywhere you look. Once the geniuses woke up and said, oh, we left the money supply on too long. Look at M1 here. That's insane. They started working with the Fed to raise short-term interest rates to slow down inflation. Now, there isn't a direct correlation between short-term interest rates from the Fed and mortgage rates, but obviously there is some impact as we are seeing now. So what has all this meant to housing? Well, here you go. First, let's look at the supply as defined as the number of homes for sale in our local South Orange County real estate market. These are homes that are for sale but not in escrow. Inventory is up 97% compared to this time last year, but as you may recall, at this time last year we had extremely low inventory rates. We were going down to almost zero for some of the cities around here. So not really a good comparison. If we look at 2019, we're actually half of what we had for sale in 2019, about 50% down. So we have about 1,251 homes for sale here at the beginning of October, down slightly, about 2% from 1,279 that were for sale at the beginning of September. And that puts us about even to where we were back in June. This is the time of the year when inventory generally falls as you go into the holiday season. So we expect that trend to continue. So as I said, inventory is down about 50% from 2019. Part of that is the number of homes that are being listed for sale. So those are new sellers coming on the market. Year to date, we have about 9,000 homes that have come on the market, which is a 20% decrease from this time year to date last year, and about 20% less or fewer homes that came on the market in 2019 through September. In fact, it's the fewest number of homes to come on the market in over 12 years. So you may recall from last month's update, sellers were playing hide and seek. But what have buyers been doing? Well, let's dive into that. Demand can be measured by the number of homes in escrow. That's the number of buyers that are writing contracts and opening escrow, putting their money down to buy a home. Demand did decrease in September with 670 homes in escrow to start October, down from 753 homes. So it's about an 11% decrease. As you may recall, the peak of demand was in April when we had about 1,051 homes in escrow. So escrows continued to lag 2021. For the 13th month in a row, the number of homes that closed escrow was down compared to the previous year. So this is a little bit longer term trend. Year to date, we're down 32% in the number of homes for sale or units from 2021, and we're down 9% from 2019. So while decreased demand continues to be a theme or a subplot, it's not the total story. So that brings us to our market index, and how does that look this month? So it's been fairly steady. We went from 178 to 187 in the month of September. What does that mean? So for every 100 homes in escrow, you had 187 for sale. So not quite 2-to-1 ratio. And remember, back 8 months ago, we were 1 to 2 ratio. So it's definitely changed, but still a 2-month supply is very low supply. And we're still below the 2 to 1 ratio that we hit in August. So still tipped more towards the seller's market, but holding fairly steady. Most of South Orange County cities have less than a 2-month supply. Rancho Santa Margarita is on the low end at 1.3 months, and Dana Point continues to be on the high end at about a 3-month supply. So what have rising interest rates, low supply, and slowing demand done to pricing? Well, as we mentioned at the beginning of the video, prices actually went up in September about 3% on average, and that's for a dollar per square foot basis. What drove that? Well, we saw a slight dip in August of interest rates. Buyers did take advantage of it, and if you think of a 30-day escrow, they're then buying in August, closing in September. That actually drove prices up. As everyone was saying, oh, prices are crashing, they actually went up, and that's what we saw in September. So we're up about 17% compared to this time last year, down about 4% from the peak, up 51% from December 2019. So it's all relative. Are we up? Are we down? The answer is yes, we are up and down from the peak. And that was in the April-May timeframe. Remember to subscribe so that you get these updates when they come out. We try and put some useful content out there for you. So you might ask, why are sellers not cashing in on record prices? And there's a couple things to look at. 30% of sellers are paying less than a 3% mortgage. Let's say they got a mortgage at 2.875 and now they're looking at a 7%. That's about a 61% increase if they got the exact same loan. So their payment would go from in the 6,000s a month to in the 10,000s a month, about a $4,000 difference. Huge. So a lot of sellers like, I'm just gonna stay here, enjoy my low interest rate and pay it off with inflated dollars. So they're playing that side of it and just gonna stay home. Now, one of the things that we hear a lot is, well, I remember when interest rates were 18%. And in fact, when I met Vickie, her interest rate on her condo was 9 5/8. Quickly refinanced that to 7 1/4, which coincidentally is about where we are today. However, that condo back then was worth $150,000, not $750,000. So, even though the interest rate is what we've seen in the past, the dollar amount is different, and so that is impacting buyers probably more than it did back then. So what's up next with the Fed? They're probably going to be raising rates, again, trying to control inflation. What's that going to do to housing prices? We'll check back here next month to see what it did. I think we're going to have a little bit less volatility going into the election in the next month, and then it could get rough waters again. That's what we're here for. Help you navigate whether you're buying, selling, investing. Every house is different, every neighborhood is different, and some zig when others zag. So if you want to know how this affects your particular home, or maybe a home that you're looking to buy, give us a call. That's what we're here for. I'm Jim with the Bishop team, Berkshire Hathaway Home Services, California Properties.